Today, we're diving into a question worth trillions of dollars. When a tidal wave of foreign money pours into a country, is it a powerful engine for growth, or is it a Trojan horse? We're talking about foreign direct investment, FDI.
And this is a debate that really pits massive opportunity against some very serious risks. I mean, is all that foreign cash the golden ticket for a nation to finally unlock its potential? Or does it hide dangers that could end up wrecking the local economy?
So, let's get on the same page. What exactly is FDI? Well, the World Bank's definition is pretty clear. It's an investment where you're trying to get a lasting interest in a foreign business. The magic number is usually owning at least 10% of the voting stock. So you see, this isn't just about buying a few shares on a foreign stock market, it's about a company planting its flag and setting up a real presence in another country.
And the scale of this whole thing? It's just staggering. Just look at the period between 1991 and 2000. The amount of FDI flowing into developing countries absolutely exploded. It shot up sevenfold. So this is not some theoretical classroom debate. We're talking about trillions of dollars that are actively reshaping our world right now. Okay, so we've got a handle on what FDI is. Now, here's how we're going to break this all down. First, we're going to look at the sunny side, the optimistic case for FDI. Then, we'll flip the coin and explore the pessimistic case against it. After that, we'll get into why the answer is, well, way more complicated than it seems. And finally, we'll try to figure out why on earth economists are still arguing about this.
All right, let's kick things off at the optimists. From their point of view, FDI isn't just helpful, it's one of the most powerful tools a country can possibly use to light a fire under its economy.
The argument here is that FDI is like a total economic upgrade package. It's so much more than just a big check. It can bring in brand new technology, cutting-edge management techniques, and really valuable training for local workers. It can plug a country into the whole global supply chain, create a ton of jobs, and even help it sell more of its own stuff to the rest of the world.
And this isn't just wishful thinking. According to researchers like Borenstein, the real superpower of FDI is this thing called technology transfer. They argue that because foreign companies bring in the latest tech, their investment can actually be way more powerful for growth than a country's very own domestic investment.
And this next point just brilliantly illustrates that. A big study of Latin American economies by De Gregorio found that between 1950 and 1985, a dollar of FDI was about 3 times more efficient at driving growth than a dollar of local investment. I mean, think about that, 3 times.
So it seems like an open and shut case, right? FDI is amazing. Well, not so fast. Because for every one of those optimistic arguments, there's a much more skeptical, pessimistic view waiting in the wings.
So let's flip that coin. The pessimistic argument is that foreign investment can bring some really serious and sometimes totally hidden costs for the country that's welcoming it in.
And this really gets to the heart of the counter-argument. You know that amazing technology transfer we just talked about? Well, pessimists say that can turn into a market stealing effect, where powerful foreign firms just take over everything. That big injection of cash, it could actually end up crowding out and killing off local businesses. And what looks like healthy competition can turn destructive really fast, leaving a country dangerously dependent on outsiders.
There's this whole school of thought that doesn't see FDI as a helping hand at all. Instead, it's seen as a calculated, aggressive move by massive multinational corporations to gain a monopoly. They use their huge advantages in tech and money to just steamroll the local competition.
And there's real-world data that seems to back this up. In Venezuela, for instance, researchers looked and found zero evidence of those promised tech benefits spilling over to local firms. A study in Morocco? It found no positive effect on growth. None. And in China, one study even argued that because of all the special treatment foreign firms got, they actually ended up crowding out local investment.
So, what do we have here? 2 completely opposite stories. FDI as the hero, and FDI as the villain. And whenever you see that, it usually means the truth isn't a simple yes or no. The real answer is probably, it depends.
See, a whole other wave of research came along and said, hold on a second. They argue that the good stuff from FDI doesn't just happen automatically. It's conditional. A country has to be ready for it to really reap the benefits. So what are these magical right conditions? Well, researchers point to a few key things. First, a country needs a certain basic level of income so its workers can actually use the new technology. It needs a decent financial system to channel all that new money effectively, and it helps to have an open trade policy to really maximize the benefits.
The thinking is, if you don't have these building blocks in place, FDI might not deliver on its promise.
Now, that sounds pretty reasonable, doesn't it? It's a nice middle ground. The benefits are real, but you've got to be prepared for them. But what if even that isn't the whole story?
Yeah, not even close. This is where the debate gets really tangled. Because then, another major study, this one by Karkovich and Levine, came along and basically threw a giant wrench in the works. They went back, looked at all the data again, and challenged all of those conditions. Their conclusion was that even when those right conditions are in place, FDI still doesn't seem to have a reliable, positive effect on growth.
And that brings us right to the heart of the whole problem. Why is it that after decades of research, with mountains of data and armies of economists, we still can't get a straight answer on this? The reason this debate just keeps on going isn't really about politics or different opinions. It's about how incredibly difficult the research itself is. The data is a mess, and the tools they have to study it just aren't perfect. Just think about how tricky this is. How do you separate the impact of FDI from a million other things happening in a country at the same time, like a policy change or a drought? How do you compare FDI in the tech sector to FDI in mining? They're totally different. And here's the biggest one. You've got this classic chicken and egg problem. Does FDI cause growth, or do countries that are already growing just naturally attract more FDI? These are huge statistical headaches to solve. So, because of all these deep, messy problems with the research, it becomes nearly impossible to say for sure, here is the one true standalone impact of FDI on growth. You just can't isolate it cleanly enough. And this quote from DeMello just nails it, I think. He says that the idea that FDI helps growth is way less controversial in theory than it is in practice. In other words, on a whiteboard, it makes perfect sense. But out there in the real, messy world, the evidence is a complete puzzle.
Which leaves us with one last, very practical question. Let's say you're the one in charge. You're advising a developing nation, and you've seen all this conflicting evidence. What's your advice? Do you tell them to roll out the red carpet, focus on the incredible opportunities, and hope for the best? Or do you tell them to build up their defenses, to brace for the very real risks? That is the multi-trillion-dollar question at the very heart of this entire debate.